Good morning. I guess afternoon. We'll go. Good morning. Good afternoon, everybody. Thank you for coming. I'll call our meeting of the Budget and Fiscal Affairs Oversight Committee today to get together today. I'm having issues that the speaker had earlier today. He said the vote on House Bill 162 was 210 to 0. I think he meant the vote on, because we only have 180 members of the House. I believe he meant the vote on House Bill 210 was 162 to 0. But sometimes we get things backwards, and we're going to try to do better at that. We have on our agenda, and if the committee will allow me, this afternoon, presentations from the Employees Retirement System of Georgia and the Teachers Retirement System. And to be clear, and for the public that may be listening, we have a retirement committee in the House, and we're not trying to get into Chairman Battle's business on how they deal with retirement, and all the bills go through there. What I would like us to do after hearing this presentation today is look at these two systems, as well as some other long-term financial obligations the state has, from a fiscal aspect of how we can help and bring forward, perhaps, better vehicles in order to fund these things on an ongoing basis. And to be clear, nobody, and I told both of our presenters today, and to be real clear for all of our employees and all the teachers, all our retired employees and all our retired teachers out there, this is not in contemplation of taking any defined benefit away from those that have it now, but there may be ways to be faster, better, stronger, and provide better opportunities for providing for retirement on behalf of people. So we don't have any preconceived notions, but we'd like to look at how we are here, what the systems are, take a presentation. I've asked each one of the gentlemen to 7 to 10 minutes and give the committee time for questions, and make this a first step as we look forward to long-term obligations that do exist based on a defined benefit system that is left over, I guess, is phasing. You'll talk to us about it in ERS, and then it is the system in TRS. So without further ado, if the committee has no questions, I'm going to turn it over to our presenter. The first one will be from the Employees Retirement System of Georgia. You have if I can pick the right microphone, we're going with table mic, see how we're doing.
Thank you, Mr. Chairman.
Yes, sir.
Members of the committee, I'm Jim Potvin. I'm the Executive Director of the Employees Retirement System of Georgia. The ERS is responsible for 5 statewide defined benefit plans. Of course, the ERS, the flagship DB plan for state employees, the Public School Employees Retirement System, which is the non-teacher, non-certificated, custodial, bus driver, kitchen personnel, the Legislative Retirement System, the Judicial Retirement System, and a small supplemental benefit for the Georgia Military Retirement Fund. We are also responsible for 3 defined contribution plans, the state's 401k and 457 plans, collectively known as the Peach State Reserves Program, as well as a savings plan for part-time employees known as the Georgia Defined Contribution Plan. We also have a legacy life insurance program, which is closed to new hires at this time. From the standpoint of the defined benefit systems, the single measure, if I were to pick one measure, the most commonly used measure of financial sort of snapshot of where we are, is what we call the funding ratio. That's the ratio of the actuarial value of assets to the liabilities that are calculated in the plan. We use that as a snapshot for our defined benefit programs. Most of you are probably aware that in the late 90s, early 2000s, that was pretty much the peak of where the ratio was. We exceeded 100% pretty much across the board in our systems, with the exception of the GMPF, which didn't exist yet, and the JRS, which at that time was a brand new plan. After that, due to largely external events, namely the 2 market crashes in the early 2000s, we went on a long period of decline in the funded ratio, about 12 years. Starting 2 years ago, we've been able to turn that around. So 2 years ago, and then again last year, for the first time in a number of years, all 5 systems saw their funded percentage improve. We've taken a number of steps in the intervening years to try to put the systems, particularly the ERS, which is where the bulk of my comments will focus, on a better footing. The most dramatic one is the creation of the 3rd tier of the ERS plan, which we know as GSEPs. That's the tier which has now a reduced defined benefit. Instead of a 2% final average pay plan, it's a 1% final average pay plan. So it's about half of the defined benefit that was previously provided, with the addition of a 401k program with a corporate style matching contribution. So if a member saves at least 5% of their compensation, the state will match up to 3% of compensation for a total of 8% of compensation into the plan. Now they can save more than that if they wish, but that's where the match ends. So we're essentially at a point where approximately now half of our population is in the GSEPS program, or active population, I should say, and contributing to both the 401k, and they also have this defined benefit as well. Just to give you an idea of how the 401k is working, about 90% or so, everybody is auto-enrolled in both the DB and the DC plan. The DB plan, it's mandatory participation. In the DC plan, the 401k, it's voluntary. So we auto-enroll people in, and then they can decide whether or not to stay and at what level of participation they want. About 90% do stay in the plan, so about 10% opt out at any given time. Approximately 60% of the population is saving at a level that will get them the full match. So the other 30% is saving less than 5%, but more than 0. The market value of assets of the system, ERS, is about a $12.5 billion fund. The total of all the funds is about $15.5 billion. So ERS is by far the biggest system that we manage. We pay out about $1.3 billion per year in benefits from the ERS plan. An average monthly benefit for ERS of about $2,300 per month. That number has been coming down in recent years for a number of reasons. And it's not really due to GSEPs yet, because most GSEPs people are not eligible to retire. So that trend will continue once those people start retiring, because they will have smaller benefits. Changes that we've made to the plans on an actuarial basis to try to put them in a better position going forward. Like I said, the GSEPs tier is the most dramatic, but there's some other things that we've done as well that are maybe not so apparent just by looking at the front page of an actuarial valuation. Probably the most important one was changing the way we amortize our unfunded liability. So as the unfunded liability grew throughout the early part of the 2000s, our policy at that time was to amortize it over what we called a 30-year open period. So the next year's actuarial contributions, which would include a payment to amortize that, would be done, assuming that it was going to be done over a 30-year period. But the 30-year period was being reset each year. Effectively, it makes it very difficult to get back to your goal of 100% funding if you're resetting the amortization period every year. So what we did is we closed it, essentially setting a target date in the future by which the unfunded liability that existed as of that time would be completely amortized. We also reduced the period from 30 years to 25 years. So essentially in 2013, we set a target date of 2038 for that portion of the unfunded liability, which is going to be by far the most of it, to be fully amortized at that point, with the board explicitly stating that their goal is 100% funding in the ERS. So all future valuations are done, and the contributions are calculated with that in mind. The other thing that we did with regard to the amortization, there's basically two ways to do that calculation. One is what we call level percent of pay, which essentially assumes that you're going to have a constantly increasing payroll. And in most time periods in our history, that's true. You know, we're adding employees, or just in general, they're getting raises, and so the overall payroll base is growing. But what happened with ERS from 2008 to the present time is that our active membership actually declined from about 75,000 members to the 60,000 of today. So it's about a 20% decrease with a concurrent decrease in our overall payroll base. So it didn't make any sense for us any longer to assume payroll was growing, and so we changed to a level dollar amortization, which essentially is the way that you finance, say, a long-term purchase such as a car or a house. You're going to have the same monthly payment every year for the duration of the amortization period. Essentially, that front-loaded the amortization and got more dollars into the system earlier. The end result of those two things, as well as just the need to react to the poor investment returns that we had in those two separate occasions, the net result of that was an increase in our contribution rate, a fairly substantial one, where we went from about a $275 million a year total employer commitment to the plans to now where we're about double that, 550, 560, 570 in that neighborhood. We have fully priced in the increases that actuarially we project to need. And so for the foreseeable future, at least, what I see are pretty much flat contribution rates from us going forward. The dollars may change a little bit depending on whether or not we start to hire employees again, but basically it would be on a proportional basis to our overall member population. There are three basic ways to get money into the system: employee contributions, employer contributions, and investment returns. Employee contributions in the ERS are fixed by statute at a relatively low 1.25%. The only way that we could change that would be for future hires, or if we wanted to do it for current members, we could do it, but we would have to add a benefit to the plan that basically offsets any benefits that we would get from doing the increase in the first place. So essentially, we're locked in for current employees at the 1.25%. As you well know, the employer contribution rate is the variable in that equation. Investment returns are the third and most significant portion of that. Approximately 60% or more of the benefits that we pay out come from investment returns. If you look at investment returns over time, the last 2 years have both been below our stated goal of 7.5%, which we price into the valuations. 4 of the 5 years prior to that were in the double digits. So we're at 7.5% assumption. We were getting more than 10 in 4 of those 5 years. So on a year-to-year basis, the results of our investment are very tied to the overall markets and can be quite volatile. For that reason, we view the 7.5% and any decisions we make about that and our investment allocations as long-term decisions. The question then is, what does long-term entail? I think of it this way. We have individuals, members of the plan, that may start working in their early to mid-20s and be members, actual retirees, until they're in their 80s or even later than that. So many decades of membership. I don't know that I would argue 70 years is the appropriate time window, but if I told you that 30 to 40 years is an appropriate long-term time window, I think I could make a good argument for that. What we see then is that we get pretty good volatility in short time periods, but we don't want to make decisions that change our investment mix or even the actuarial valuation assumptions too dramatically in reaction to 1 or 2 or 3 years of investment performance, good or bad. Our 25-year investment return, average investment return, exceeds 8%. So I do feel like on a long-term basis we have done the right things from that standpoint. This year, I'd say the last 2 years we did not meet that. This year we are on track to meet our target. We are currently at about that 7.5% to 8% range. So this year looks like it'll be a good year. But long-term, won't result in any dramatic changes to our philosophies either. So with that, I will pause and be happy to take any questions.
Thank you. The committee have any questions, gentlemen? Yes, sir. Representative Tarbin.
I'm very hard of hearing, so you may. Just teachers participate in this, or administration, or they have to be?
I handle the major pension plan for general state employees.
Okay.
So that's executive branch agencies and some others.
Okay. Are any of these people allowed to participate in Social Security, or not allowed, or do they? Or
pretty much all of our members are in Social Security.
Thank you, sir.
Is that you, Representative Jones? Yes, sir.
Yes, sir. Good afternoon. Thank you. Just real quick, we have this handout here, and on the bottom it talks about the pooled investment returns, and other than the 25-year, that's the only one above 7.5. So can you give me just a little bit better of an explanation? You had mentioned the last 2 years you were below the benchmark. Before that, you had been hitting the benchmark double digits. So maybe the bottom is not correlating with maybe the data that you're giving us, and I just want to get clear in terms of that return because of the fact you mentioned it's 60% of the payout.
It is actually correlated. So in the last 2 years, 1.4 and 3.7%. The 2 years before that were both in double digits. The year before that was about 2%. And I can get you the specific numbers.
Okay.
The lowest one, which are included in the 10-year numbers, were two negative years, 2008, 2009, where we had about a negative 13 and a negative 2 or 3 in back-to-back years, and those were the really damaging ones. Part of what you see in the numbers at the bottom is selective endpointing. So 2 years ago, before we had these last 2 years, our 10-year number would have been in the 8 to 9% range. 2 years from now, or next year, it'll actually probably be lower because our 10th year out is a 14% year, I believe. But 2 years after that, it's going to skyrocket again because we're going to drop off those negative years. So this is what I say if you see this chart from year to year, it changes pretty dramatically.
Sure.
The 3-year number last year, I think, was 11 point something percent. So it does track, and if it will help, I can get you the year by year for the last 10 years so you can actually see it.
Mr. Chairman, I'd be interested in that.
That'd be great.
Happy to. And I'll send it, I guess, through to the chairman's office.
That'd be fine. We'll disseminate it. That'd be great. Further questions? I have one, and I don't want to get too much in the weeds. I think probably Representative Jones is much better to talk to the specifics. But I guess what I see here in the defined benefit plan, and correct me if I'm wrong here, is it's funny, you mentioned the 3 things, assuming the liability change, and I know actuarially those could change, and you look at that every 5 years, I think, right, about lifespan and so forth. So, I mean, you could change your bogey out there that, you know, the same number of people are retiring, but actuarially they're living longer, therefore you need more, and then you have to push the value back, you know, and that affects the pool. But given the same end, the payout over time, same life expectancy and so forth, the 3 things, I love the way you did that, is that can change that is the employees put more in, the taxpayer puts more in, or we get a better return. In your remarks, I think I heard in loud and clear, there are really only 2 of those that can change, because we can't change the 1.25 that the employees put in. Because if we do that, there has to be a corresponding benefit that goes. So it's going to be revenue, if you will, in our terms right here, revenue neutral, right? Okay, so that's the cards we're dealt. So there are really only 2 ways to make sure that you build back to to the 100%, and that is return and the taxpayer budget every year. I guess what we've had conversations around over time about your ability to invest in certain areas. You know, is it a risky investment or is it not a risky investment? I mean, I forget is it the beta? Am I right? It's been a long time since I had finance investment, but when it's a high beta, it's a risky investment. If I recall, it seems like we're swinging pretty wildly with these so-called conservative investments that you're able to get into. The question I would have for you is, if you were able to invest in other things, we had the Firefighters Fund come to us this year and ask to be able to do more in alternative investments, which, you know, we had tried to offer you a few years ago, and your members or others had said no, or even in real estate. Is it not true that if you could widen the base of your investments, you would have, you know, a lower beta in return? Because it seems like in the years you're doing well, you're doing really well, but in the years, I mean, it doesn't seem like we're very nimble in being able to get out of equities when the market's heads down. And I mean, hindsight's always 20/20, so I don't want to pick on you that much, but given how you have to invest, do you have the leadway to be as nimble as you would be if you were investing this in a private funds?
So I guess there are several points that I should address within that. Number one, from an overall management of the fund, you do have to look at both the assets and the liabilities. I don't want to just say all things being equal, because all things are never equal from that standpoint. That's why GSEPs has actually been fairly important for us. Our liabilities in our plan have virtually stopped growing, partly because of GSEPs and partly because we've not paid COLAs for the past number of years, and that's obviously a decision that we would like to reverse at some point in the future when we get to be able to do that. But liability management is important to us, and so for us, getting back to the 100% will be important, but growing our assets beyond that won't be, because our liabilities haven't moved that much. Second of all, we actually did pass an alternative investments bill a few years ago for the ERS only. It's the teacher's plan that doesn't have it at this point. We're very limited in what we can do. No more than 5% of the portfolio can be committed which from a practical standpoint in the private equity space means that you're never going to be more than 2.5 to 3% invested
Because of the draws.
because of withdrawals.
Withdrawals,
Exactly right. There was also a intentional slow ramp up to that full commitment, so we could never commit more than 1% of the portfolio in any year until the first point at which we hit pretty close to that limit, and then we can do what we need to do. So right now, it's less than 1% of the portfolio, about $100 million or so is currently actually invested in private equity. It's a relatively small portion, doesn't have much impact on us at this point. I can't say for sure that I will never come back to you and ask to expand that out, but for now, since we're not anywhere close to our limit, I think we're happy with the way things are statutorily for us. Third, nobody can predict short-term market movements. You ask 10 experts, you're going to get 10 different opinions. And so it is not, our Division of Investment Services would tell you that nobody's going to try to jump in and out of equities, for example, to try to mirror what the market's doing or try to anticipate what the market's doing, because nobody can do that on a consistent basis. So what they do is they try to set their sights on longer term. If we're going to buy a particular stock, can we see that being an underlying good business for a number of years? Are there barriers to entry? Do they have structural advantages? Do we trust their management? Those kinds of things are what inform the decision to purchase equities. Not so much, geez, the market's overvalued, so maybe we should think about getting out. Now, look, they do management of it, right? They get to a certain point and they'll trim their positions and that kind of thing. But large swings for us, a large swing in our equity allocation in a year might be 2%, 3% of our total portfolio. Other than the private equities, we're pretty much a stocks and bonds kind of a shop, about 70-30 depending from year to year. And equities and frankly bonds are volatile investments in and of themselves. I mean, just look at what the S&P 500 does from year to year, for example. And since we're a large entity, we don't mirror the S&P, but we're obviously closer to it than a $100 million fund would be. Bonds, I've been predicting for years that interest rates were going to turn up, and that hasn't happened yet. But eventually, I'm sure I'll be borne out like the stopped clock is. And so that will have a great impact on the supposedly safe, bond prices. So whether or not something is safe doesn't necessarily correlate to its volatility 100%, I would say.
Well, I'd like to go into that further, but not in our time today. I think this is a good start. I would point out one thing is that, if I'm not mistaken, last year was budgeted a 13th payment that in lieu of a COLA. So
That's right.
I would point out that even though ERS did not do what TRS did a number of years ago, which they decided to pay for a COLA, the legislature did, in fact, budget a 13th payment.
Absolutely.
It was not all equal, and quite frankly, it was strange the way it applied with its maximum benefit and so forth. But just point out that we did that. We have one more question before we move on to the next printer. Yes, ma'am. Ms. Frazier.
Oh, yes,
Representative
thank you.
Frazier.
Apologize for coming in, and did I hear the word solvent, that the TRS is solvent? Did anybody use that word? That we're good?
Yeah, I'm ERS.
Well, as it relates to the COLA, how is that projected in the salaries? And I know you said it hadn't been paid in a while. We haven't had a cost of living allowance in a long time. And so how is that programmed in when you all are doing investments?
It's a good question. So the statutory requirement is very broad for the board. The board basically many years ago decided how they would handle COLAs per their discretion. And what the ERS board decided was that they would do so on an ad hoc basis only going forward. What that effectively means is that at this point there is no assumption of any COLA payment other than that which has already been paid in the actuarial evaluations. So the actuaries actually assume zero for COLAs forever until the board actually decides to do one, in which case that gets built into the next valuation and valuations going forward.
So, Mr. Chairman, I guess our next meeting will be with the board.
We can invite the board in, but I think it's real. And again, I want to put the gentleman in a place that he is between his board and the committee.
Oh, of course.
I do want us, it's a good question, Representative Fraser, but I do want to be careful. I want to be careful we don't cross into Chairman Battle's land, because I know the retirement committee deals with the various boards and works on the COLA. But I do think it is important to point out again, the teachers' retirement system, and somebody can point out when they come up here, a number of years ago decided, I believe, to pay 1% more or somewhere in that neighborhood in order to achieve the COLA. I don't know if that was asked or not asked of the employee, the ERS folks, but I know it was not done. So the decision was made by employees that they didn't contribute to their COLA. That's the reason ERS has one, TRS has one, ERS doesn't. Mm-hmm. And you know, at this point, we're actuarially funded in ERS at 74%. So it's a bit difficult to pay additional monies out of there when you're funded at less than 100% of the system actuarially. But that's a good question. I don't see any further questions for you today, but I do thank you for coming by. And sorry, I know there was a bit of confusion about the timing and so forth of the meeting, but we do appreciate it. Last week we were trying to coordinate with Chairman Battles, and then there were some room issues, and we really appreciate you coming by. So thank you, and if you have time to stay, the committee members may have a question when you're finished. If you have to go, we certainly understand.
No, I have time to stay, and I just want to point out I'm certainly at the committee's service. If any of you wanted to ask further questions or have me come by, I'm certainly happy to do so.
Thank you very much. Yes, sir. As he's coming up, allow me to introduce Mr. Buster Evans. He's the Executive Director of the Teachers Retirement System of Georgia. Actually, both bigger in terms of membership, not that we're getting into a battle of assets with the gentleman, but you have quite a few more members, both paying currently and retirees and an asset base. Welcome.
That's right. Thank you, Mr. Chairman, committee members. My name is Buster Evans. I'm Executive Director of the Teachers Retirement System. I've not been around as long as Mr. Potvin has been on ERS, but I'm equally as excited about and confident and enthusiastic about the retirement plan for our members being a part of their compensation as a part of their for their lifelong service in public education. Our systems are similar in some respects, but there are a few differences. And rather than repeating a lot of the things that Mr. Potvin said, I'll take an opportunity in a few cases to point out the areas where we may be slightly different. First of all, we do serve K-12 education as well as the Regents, the library system, technical college system of Georgia, and also our county extension agents who are part of the Board of Regents system as well. So those are primarily the areas that we serve. We are a large system. We have about 350,000 total members. That breaks down to be about 120,000 retirees, and we have about 227,000 actively contributing members. This is on page 2. As we go through the presentation, there are a couple of things I will point out to you that we've seen some changes over time, and which have resulted particularly in the ARC that you guys supported as a part of the FY18 budget. So I'll try to make sure that I give you at least a little bit of commentary to help explain why that happens. We do have $68 billion in assets as of February 1. It's been a great first 6.5 months of the year, and we're really thankful about that. They say that hope is not a good strategy, but one of the things that we certainly hope for when it comes to our retirement planning is for a couple of years of good double-digit returns on our investment, because that means that we won't be talking about ARCs and things like that to the same magnitude that we have this year. But we do have, as I indicated, 119,000 beneficiaries who get a retirement check from Teachers Retirement System every month. That I'll share in just a moment how that breaks down. Our typical retiree retires with 30 and a half years of service. Nearly 59 years of age is the typical retiree at their point of retirement. Again, that average benefit per month is about $3,209 for those retirees who retired in 2016. Going on along, we are at 79% funding level as of June 30th, 2015, and we use a year in arrears for our actuarial assumption on that. So our representative mentioned use a question solvent. We certainly think so. I'd point out that the teachers' retirement system sits in the top 25 to 30% of funding ratio percentages of districts in the system, and we're about the 24th largest retirement system in the United States. But we are currently at 79.1% and relatively stable within that range as well. As was talked about in Mr. Potvin's presentation, there are basically three ways that we maintain that sustainability. First of all are the contribution rates that are set in place for the employees. We are higher than ERS. We are at 6%. Part of that reason for that level being there is, as has been pointed out, that COLA is factored in for that retirement benefit. So that factors in for the actuary to be spread out across both the employee contribution and the employer contribution, thereby basically coming up with what's sometimes referred to as a pre-funded COLA. But it is currently at 6% where we are capped by state law. The employer contributions have gone up for FY18, assuming it does pass the other side of the legislature and signed by the governor, to be at 16.81. We talked about the investment rate of return being at 7.5%. We've done some recent study just to ensure. Of course, our actuaries look at this every 5 years. We look at it on a regular basis, comparing ourselves to other retirement plans across the country. We're actually slightly under. If you took a modal number, it'd probably be about 7.5. The mean number among the roughly 300 retirement systems that we looked at through the National Institute of Retirement Security, they run about 7.54. Assumed rate of return going from the lower to the higher. So there has been a trend nationally in moving that assumed rate of return down. So we are still slightly below the mean, but we'll continue to look at that on a year in, year out basis. One of the things that you may hear a question talked about during the coming year, as that employer contribution goes up, which in essence is the ARC, that is spread between both the state funding as well as local funding. So local districts, to some extent, may bear a part of that burden. And so let me explain sort of in layman's terms. First of all, if you have a school system, for example, that has very few what we would call locally funded teachers or teachers above what they get from the state allotment sheet, they wouldn't have a lot of increase. Or if they don't pay a very high supplement, they would not have much above and beyond. If you're a district that has a large number of employees above your state earnings and you pay a large supplement, your proportion of what your local share of that cost would be higher. So just to clarify, that ARC, though, covers certainly the larger percentage of what is going to be that employer contribution increase. So that is just a little bit of an explanation about those employer contributions. I won't spend any time on 7, which talks about historical contribution rates going back to 1980, other than to say you'll see in 1980, we were at 6% during the good years of the 90s. Late 90s, we got down to as low as 5%. And then now we are back up to that 6% level. On page 9, I do want to talk just very quickly about things that impact contribution rates. And there are 5 things here. First of all, actuarial assumption changes as we look at various things such as wage inflation, option factors, demographics. Those are part of the studies that our actuaries do. Secondly, our investment earnings. Again, we hope for a few good years of good double-digit investments, returns. That would be great. Investment earnings assumption changes. If we change that assumption rate, would impact actuarially our funding levels. Increases and decreases in actively contributing members, as well as increases and decreasing in member salaries. And I want to point that out as we go a couple of pages in. Now, looking at our return over time, and one of the things that Mr. Potvin was talking to as we look at this expectation over a long period of time, it actually does look favorably toward that 7.5% rate of return. If you look at our 20-year rate of return, even though that has dropped down through the FY16 at 7.2, if you go back every year prior to that, you will see that was the first year that we had actually, on a 20-year average, dropped below that assumed rate of return of 7.5%. So again, with a good rate of return this year, we could very well, and we would expect that number to again get above 7.5%. Probably equally as important of a factor, and I lived through this as a school district administrator between 2007 and 2014. If you'll look at the number of people who are contributing members on page 11 in 2009, you'll see Georgia reached a high of 226,560 people who are actually paying into the system. But as a lot of districts had to do to make their budgets work, basically looked very carefully at their budgets. In many cases, got class size waivers. In many cases, did not hire positions. You saw our active contributing members drop down to a low in 2013 of 208,000. And we're back up to about 218,000, which is about 8,000 less than it was at the high of 2009. So in essence, we've got about 8,000 fewer people contributing into the system today than we did in 2009. Second part of that number is our retirees continues to increase. There's not a huge jump, but it is a relatively stable increase year in and year out. But the gap has closed between the number of active contributing members and the number of retirees. And, we know that has an impact on us, and I think it's one of the things that actually has contributed to the ARC equally, if not more so, in terms of the rate of return. The good news is if you look short term, even within the last year, we do see this number ticking up. And I could go into a couple of reasons why we believe those numbers went down, because there's several answers to it, but it was all a part of districts becoming very fiscally responsible during times where their revenues were being reduced, and they did what they needed to do. The good news of that is if you look at taxpayer cost, that means that there were nearly 8,000 fewer people getting a salary from taxpayers today than there would have otherwise been, despite the fact that Georgia's student population at the K-12 level has increased 107,500 students. And I think half those might be in Forsyth County, Representative Gilliam and Jones. But anyway, that is a number that we continue to look at. We do believe and like to report out on the economic impact. We're always willing to show you by your representation district or your county what the economic impact is. But for the total economic impact per monthly payroll is about $530 million, with an annual Georgia economic impact of over $6 billion. I've gone over some of these in a hurry. I'll be delighted to answer any questions that you have, and if you need additional information that we can't answer today, ensure that we provide it to you.
Thank you, Mr. Evans. Questions? Committee have, gentlemen? Questions? Oh, I have one. Yes, sir. Yes, sir.
When you were talking about local system supplements, are local systems assessed a contribution? How, I wasn't clear.
Okay.
I made a note on
some
page.
school districts may
Page
pay a
6.
supplement to a teacher
Right.
and or administrator.
Right.
So that local supplement is not calculated, is not a state revenue. That is a local decision. So consequently, if they're paying a local supplement, whatever that retirement liability is for that would be 100% borne by the local system on that local teaching supplement or administrative supplement or whatever. Just for example, if their supplement's $1,000 and their employer contribution rate is $200 is 20%, that means $200. That complete $200 is borne by the local district and not the state.
Did they pay that to you for you to administer it to the beneficiary in the future?
Yes, sir, they do.
Okay.
Yes, sir.
Thank you. Representative Gasway. Representative Frazier.
Thank you, Mr. Chairman. I guess you see, this is really kind of interesting to me since I joined the TRS 2 years ago. And I can remember when there was a pay raise once per year, and now they're doing it in two increments. And can you just explain to me why they're doing it like that? Is it based on rate of return, or is this solely based on the CPI?
Yeah. Okay, that's an excellent question. It is basically established since 1997. Legislative action authorized the Teachers Retirement System Board of Trustees to provide a COLA twice a year. And the policy was established by the TRS Board of Trustees to do that COLA 1.5% 2 times a year. It is based on the CPI only from the standpoint that when you retire, you have a base CPI. Roughly right now, the total CPI is about 240. If you retire, and as long as that's the national CPI is above 240, you would always qualify for a COLA. If that CPI should drop below 240, you may not qualify for that COLA, would not qualify for that COLA until the CPI goes back above. Typically speaking, in the last COLA administration that we gave in January, every retiree who was eligible for a COLA did receive the COLA. And the only ones who would not have been eligible were those who had not been retired long enough to be in that window which would allow them to be.
Thank you. One more question, Mr. Chairman. On page 11, under the statistics, you talked about how we were at like 222 back in the 2008, and then we dropped to about 8,000 members, and then we went back up. Now, is that reduction because of due to not just deaths, but also due to the system, the school systems as it relates to hiring? And so what contribute to this downward and then back up? Because
Okay.
I know we're we're recruiting teachers, but we're not hiring them as fast as we need them.
Yeah, that's a great question, but a multifaceted answer, and I'll answer it real quickly. First of all, they tell me there is somewhat of a teacher shortage recurring in some parts of Georgia. Secondly, I think districts have not hired teachers back since the cuts that they made to deal with the recession because they couldn't afford to. They've received class size waivers as a part of either being a charter system or a strategic waiver, i.e. squared district, to be more flexible in how they expend their resources and how they use their personnel, of which I think is a great thing. But I think in some cases they've just not been able to hire back. In some cases it has meant that there's actually some larger class sizes in some areas, so I hear. But for the most part, I think it's a combination. I think the final thing would be not to try to answer for the regents or TCSG. There are cutbacks that were made in every educational institution or organization in the state that still have not been fully restored because basically the lack of funding, and organizations typically operating more efficiently as they needed to, which has not been a bad thing for them, but it has impacted us as a system in terms of the revenues.
Thank you. So is it not true that we need to restore more money back into the education system?
Ma'am, if you think that's a good idea, I would concur with you.
I'm going to bail you out on that one, Mr. Evans. Representative Jones.
Thank you, Mr. Chairman. And I'd like to officially go on the record and thank Dr. Evans for the great job he did at the Forsyth County School Board. So thank you. Have you guys, and if a high-level answer is fine, Dr. Evans, I'm happy to get with you offline. But when you take a look at page 4 in terms of the unfunded liability, then page 7 in terms of the contribution going up by about 72% since 2010, up to 16.8. Then page 11, where we have the blue line, which is that retiree line, pretty steep at 54% since 07. Has there been an estimate made that if you hold at the 7.5, which is a pretty strong return, what our contribution level is going to have to go up to, if at all, above the 16.81?
We do look down the road with our actuaries, so we can sort of look to see that there is a possibility. We do not have a scenario where it would exceed the low 20s%, but we do have scenarios where it could go that. Now, so we recognize that. That is why, part of my daily life is hoping for great returns on our investments, even though Mr. Potvin nor myself are actually over that division. They're a part of our organization. Second thing that we do look at internally are what are our options for greater efficiencies, conversations with our actuaries about better ways of reporting and better ways of estimating those types of things. So quick answer is yeah, we have sort of looked ahead. But, we would hope that level over the next few years would not have to escalate above the 20% level. And with great rates of returns, it would not have to reach that level.
Okay, Mr. Chairman, just very quick follow-up. Dr. Evans, estimating about every 1% or 100 basis points in terms of contribution, what does that mean to the taxpayer? Are we talking X millions? Like how many? Do you know off the top of your head?
I'm
not
sorry,
looking. I'm not looking to
Jones,
stump you.
I'm not sure that I understand the question exactly.
Every time, if we went 16.81 up to 17.81, what would be estimated the increment in terms of the amount of money that would have to go in as a contribution?
Okay, well, I can use the example that we used this year from 14.7
Yeah, there we go.
to 16.8.
Yep.
That was $223 million. So I think if you looked at roughly probably $1 million per every point.
Yep.
Yep.
Okay, thank you very much.
Does that sound right?
I'm going to do the math.
Okay, great.
Thank you, Mr. Chairman. As far as the investments, who makes the investments for ERS and TRS? Are they the same or are they different?
They are, for the most part, the same. One difference between ERS and TRS, ERS is allowed to go up to 5%, as Mr. Potvin said, in alternative investments. That same privilege has not been given to TRS for various reasons. But it is from the equities and the fixed, the bonds and stocks, the same team. Mm-hmm. And basically they are making those investments. There are investment professionals which are under the oversight of Joint Management Committee, which consists of representation of trustees from the ERS board as well as the TRS board.
Okay, follow-up question. So it looks like, I guess looking at page 10, comparing that return to what's on the ERS, it looks like the returns are about the same, even though one has alternative investments, one does not. I mean, it's pretty much.
Yeah, I think that's fair, but
there.
for all fairness too, they have not been in alternative investments long enough to really, I think, begin to see that impacting again. Not to really answer the question for him because I don't know it as well, but I think that's probably one of the biggest things. And otherwise, I think the investments are basically in the same types of same stocks and bonds.
Okay, thank you.
Mix.
Thank you. Any further questions? I had a couple, if I could. One of the things I want to go back to is, and I had actually forgotten we did get the alternative investments for ERS because I had the bill to do it for both, and then you didn't get it in TRS because a bunch of people called raising Cain about not doing it and somehow undermining it, and that's one of the things I want to get to today, because there's so much misinformation that goes on about a defined benefit system, and I guess that's because there's not a lot of them left in the world. But is it not true that, as we've seen today and as Representative Jones brought out, I mean, I think you're 223 million. I actually thought it was 233 million, but we won't quibble on, it was 220. We'll go with 223. That contribution had to get made by the state taxpayer because I think, because of return and then your liability at the end. I think you actually did a actuarial study and people are living longer, and that's a good thing. But the state taxpayer is on the hook, if you will, for that. So I'm at a pause when I get calls from educators and retired educators that are worried about, what you can and cannot invest in, because the only people that are hurt by low rates of investment are the taxpayers. Is that not true?
That would be correct.
So I'm glad to hear that you're not. I won't put you in the chair of the board and say you're endorsing alternative investments, because, as you say, if you go up to 5% and you got 10% more on the 5%, it's a lot of money to move around in a $58 billion fund. But it is important that we do that, because I actually have the bond book for the state, and the estimate next year actually calls for 400. million to be put in by the taxpayer again. And that's assuming you achieve your 7%. I think we're headed for more than that this year, so maybe that number will be lower. So my concern in reading an article a few weeks ago where a teacher just wanted us to leave it alone, because I don't see why they would mess with it. It's not, I guess, the current teachers and the current retirees, because of the very nature of the defined benefit system, anything the state would do would not mess with them. Is that not your understanding of current statute?
Absolutely, both state as well as federal retirement law,
Right.
Mr. Chairman.
So I just want everybody here that wants to come back and look at this. And again, Chairman Battles runs the retirement committee, and the whole House and the whole Senate would decide. But anything that we would look at, and the reason I wanted this committee to look over the long-term, posture of both ERS and TRS and the other smaller funds, is a way to give our people more options, our teachers more options, because it hurts me, honestly, in a world where people move around more, for a teacher to leave after teaching 5 or 6 or 7 years. That may not be leaving the profession. They may just be leaving the state because their spouse it has transferred someplace. And is it not true, if they do that today in TRS, they can take the money they've contributed, their 6%, but in many cases where the state is putting in, now 16%, last year 14%, they don't take that with them. Isn't that true?
That is true, Mr. Chairman. They take what they put in as well as any interest that it would be accrued.
Right, but in return on that. But it's not true that they also leave if they came right out of college and went to work in as most of our systems that are covered by TRS, they don't participate in Social Security.
There are approximately 25 to 29 districts, as I understand, in Georgia that do not participate in Social Security.
So we are the only retirement plan we offer our teachers. And it's a good one if you hang around and get vested. I won't say it's not. I mean, Representative Frazier is a member of it, but I just, and I'm getting on my single soapbox, not necessarily the committees, but I just think it's disadvantageous for us in hiring new people, new teachers right out of college, to not give them the opportunity to have an alternative plan, a 401k, that they can take their money and our match with them. And I just want everybody that's in the current system and retired in the current system to know that allowing new teachers to do that takes nothing away from the current teachers and current retirees. That's your understanding as well?
Yes, sir.
So I mean, I just, that's one of the things I know, because we heard from ERS that the combination is working. And I don't know of a single ERS person that is not getting what they were supposed to get. Is that true? The gentleman nods his head. So I guess I'm just looking at that with the additional dollars going in there, that we might be able to work with your board and with our folks in education to provide an even better opportunity. Maybe it's a hybrid, maybe it's a decision, maybe they can, maybe we would even offer it to people that are already teaching. If they want to move, they could move. If they're not vested, I don't think anybody that's vested is going to move. I think that's fair to say, but we could do that. Representative Wilkerson, you had one more?
Yeah, just a quick follow-up questions. Our funding percentage is at 79%, I guess, for TRS. Is that correct?
That is correct, sir.
How does that compare nationwide?
We're in the top third, somewhere between top 25% and top third of all teacher retirement systems in the country.
So that includes plans that are both hybrid as well as alternative investments and everybody.
Defined benefit
Defined
plans.
benefit only
Yes.
planning. Okay. And then I guess with the normal 401k, though, even there is still a vesting. I mean, so even if someone came in and put money into a normal 401k, you would not be able to leave after 5 years and take that matching in a lot of plans, I would assume. Is that correct?
Well, we do not administer.
No, I'm talking about it just in general marketplace terms. We are talking about the fact that a teacher comes in and they may only work 4 years, so they don't really get the benefit of that defined benefit plan. So I'm just curious, what is ERS's position on matching? Yeah.
10 years vesting for TRS, that's right.
Yeah.
So the answer to your question, Representative, is certainly specific to the design of the particular plan. ERS's 401k plan for GSEPS members has what we call a graded vesting schedule. So we vest in the match at 20% per year for the first 5 years, after which we are 100% invested in our match.
Okay, so that's good. So after 5 years, and then I guess as far as the funding percentage, though, is it, as I think about the funding? So if I come into the plan and there was a hybrid plan, would that be less money that I'd be contributing into a defined benefit plan because I'm contributing some to a 401k plan? So in essence, does that mean there's a smaller pot for those retirees that are out there now? I mean, am I putting less money into that pot? Does that make sense?
Well, if I can, let me understand from the state perspective, because from your side, it means that the amount of money that's necessary in the present day to fill that is our funded percentage. So yes, if somebody went into a 401k plan, a defined contribution plan, if you will, rather than the defined benefit plan, less money would be going in there, but it would be the state's job to make sure that we still kept the actual benefit for the defined benefit plan. But you also have to realize that we would not be accruing a liability for that individual in the defined benefit plan. Is that from your, that's how I'm seeing it from the state side. Is that how you see it from
So long as the
TRS?
amount of money coming in of those three sources, employer contributions, employee contributions, and investment rates of return, are sufficient enough to maintain the payouts to existing retirees and future retirees eligible for the system.
Correct. That's what I wanted to make sure. But
Yes.
that assumption is that a certain percentage of those employee contributions will never be realized because you figure there's going to be turnover and they'll never take that money in. So there is that assumption in there that they'll never get their money, that it's being used for the current retirees or other people that will stay in the system. So at the end of the day, I guess the state will still fund it, but
Yes.
maybe not to the maximum amount that they are now. Okay.
That's a good point, Representative, and I'm glad you made it. We have to yield to Chairman Maxwell in regulated industries, but you make a good point that, and I hesitate to call it what it might be, but I mean, to some extent, this system is funded on the account that the state's putting money in for people that never vest, and we use that money for other people and leave those teachers, those young teachers, maybe not young, it could be somebody in a second career that's just coming in to teach 5 or 7 years to do that. We leave them with nothing. And so you raise a good point, but that's the state's obligation to the current defined benefit plan. And again, it may only be my opinion, but I think we ought to offer the people coming in the opportunity to have a shorter vesting period, a 5-year window, if they so choose. Again, provide both options. Options are good. Thank you for everyone. Thank you, gentlemen, and the folks that have come with you. I see y'all have very good backup back there because people have been nodding their head as y'all have been saying. I did want to bring up one point. I won't get serial on it, but the TRS, somebody has talked to me about the salaries of some of the folks at TRS, and so maybe offline we can go into that because they did seem a little odd relative to the rest of the world that is the state, and I'm sure they're probably retiring under the TRS system, so they get a percentage of that, but we'll get to that at a different time. Anything further for the good of the order for the gentleman? Thank you very much for both of you and to the people that came. If there's no further business before the committee, we'll stand adjourned without objection. And without objection, we're adjourned.